Imagine a way to grow rich that doesn't look like winning the lottery, launching a unicorn startup, or timing the next crypto boom. A path so quiet, so boring, that most people overlook it completely, while those who understand it let time do almost all the work. For centuries, kings, merchants, and powerful families used this hidden path to turn modest fortunes into dynasties, while the rest of the world struggled from paycheck to paycheck. Today, after being buried under decades of debt, hype, and speculation, this ancient path to wealth is quietly making a comeback. And the biggest twist of all, for the first time in history, it's no longer reserved for the elite. You're watching Hidden Finance, where we pull back the curtain on the money systems, secret structures, and forgotten stories that actually shape who becomes rich and who gets left behind. In this episode, we're not chasing the next hot tip or market prediction. We're tracing a 700-year journey. From the counting houses of medieval Italy to the trading apps on your phone, to uncover the one strategy that keeps resurfacing no matter how the world changes. A strategy that has survived empires, revolutions, bubbles, and crashes, and still quietly builds fortunes in the background. Stay with me, because by the end of this story, you'll never look at wealth or your own financial choices the same way again. Look around today and you'd think wealth is all about speed. Day traders flipping in and out of positions in seconds. Social media feeds filled with overnight crypto millionaires and just as many heartbreaking wipeouts. Influencers telling you that if you're not hustling 24/7, you're falling behind. The modern world sells us a simple message. Wealth comes from intensity, risk, and constant action. Yet when you strip away the noise and actually follow the numbers over decades, a very different pattern emerges. Most people working harder and earning higher wages still feel like they're running on a treadmill faster maybe, but going nowhere. Meanwhile, a much smaller group seems to quietly get richer, even when they don't appear to be working more hours. The secret isn't just how much money they make, but how their money earns money. Because beneath the surface of every modern economy lies the same brutal divide: those who live on wages and those who live on ownership. This is the hidden path to wealth, owning productive assets and letting them compound over long stretches of time. Not gambling on them, not trading them like lottery tickets. Owning them patiently, quietly, while profits and reinvested income slowly turn small sums into large ones. It sounds almost too simple. But this idea has been the quiet engine behind some of the greatest fortunes in history. To find its origins, we have to travel back to a world with no stock tickers, no Wall Street, number 401ks. Back to the bustling ports of medieval Venice and Genoa in the 13th and 14th centuries. Here, early merchant families discovered something powerful. They could pull money to finance long, dangerous voyages, and then share in the profits when the ships returned loaded with spices, silk, and precious metals. They called these arrangements commended contracts. One partner stayed at home providing capital, another traveled and worked. If the voyage succeeded, the profits were split. If the ship sank, the capital was lost but the liability ended there. In these cramped counting houses, surrounded by ledgers and sea charts, the concept of risk capital was born. Instead of working for a wage, merchants began to think in terms of owning a share in many ventures. Each individual deal was risky, but spread across dozens of voyages, the profits added up. And crucially, wealthy families didn't spend everything they earned, they reinvested over and over into more trade, more ships, more partners. Year after year, generation after generation, their capital grew, not in a straight line, but in a slow, compounding curve that history would repeat again and again. By the 1600s, this idea exploded into something even more powerful in a small, windswept country by the sea, the Dutch Republic. In 1602, the Dutch East India Company known as the VOC was formed. It was one of the first true joint stock companies, where investors could buy and sell shares representing ownership in the business itself. For the first time, ownership in a vast, global trading empire wasn't limited to a handful of nobles or a single family. You could own a slice of the world's trade, and crucially, you could reinvest your dividends to buy even more slices. The Amsterdam Stock Exchange became a buzzing marketplace of this new idea, liquid ownership. The VOC paid high dividends for decades, sometimes over 15 or 20% in strong years. Investors who didn't just spend those payouts, but used them to buy more shares, watched their wealth quietly snowball as the company expanded. But make no mistake, this wasn't a broad, democratic utopia. The people who really benefited were still a narrow slice of society: merchants, burghers, and the already well-connected. The poor, as always, remained on the outside looking in. Across the Channel in London, the British took the joint stock concept and fused it with empire. The British East India Company, canal and railway enterprises, insurance syndicates at Lloyd's, each one an opportunity for the owning class to do something radical for its time, let capital work harder than labor. Of course, there were spectacular bubbles and crashes. The South Sea Bubble in 1720 wiped out fortunes overnight and scarred a generation of investors. But step back from the drama, and a pattern emerges. Those who spread their ownership across many ventures, stayed solvent through crises, and reinvested their income, kept rising through the 19th century. As the Industrial Revolution roared, this strategy only gained power. Railroads, steel mills, coal mines, telegraph lines, these were not just technologies, they were wealth machines for those who held claims on their profits. Families like the Rothschilds and Barings in Europe and the Morgans in the United States didn't seek riches from a single big bet. They owned pieces of many enterprises, collected dividends and interest, and rolled much of it back into new projects. The compounding effect over decades turned already comfortable families into financial dynasties whose influence stretched across continents. Meanwhile, millions of ordinary people powered this revolution with their labor, not their ownership. They built the railroads, but did not own the railroads. They worked in the factories, but did not hold the shares. Their wealth rose only as far as wages and savings would allow, and savings accounts, while safe, rarely grew faster than inflation over the long term. The quiet, exponential curve of compounding ownership remained mostly the domain of the few. Then came the 20th century, a new age of mass production, mass markets, and mass media. For the first time, stock markets were advertised to ordinary citizens as a way to get in on the boom. In the 1920s, millions of Americans piled into the roaring stock market, many using borrowed money, chasing stories of neighbors striking it rich. They had finally found the door to the owner's club, but they rushed through it as speculators, not patient partners. And in 1929, when the music stopped, the crash destroyed savings, trust, and the very idea of investing for a generation. Yet even amid the ruins of the Great Depression, the hidden path to wealth did not disappear. It simply retreated into quieter channels. Old money families, conservative institutions, and long-term owners who had survived the storm. They bought when stocks were cheapest, held through the fear, and collected dividends while the economy rebuilt. By the time the post-war boom arrived, they were positioned to ride one of the greatest wealth expansions in history. Once again, ownership compounded in the background, while most people focused on jobs, wages, and day-to-day survival. After World War II, something extraordinary began to happen, especially in the United States and parts of Europe. Governments expanded homeownership, education, and crucially retirement systems. Through pension funds, many workers became indirect owners of stocks and bonds for the first time, even if they didn't realize it. The factory worker might not hold shares in their own name, but their pension quietly did. Without knowing the term, millions had been plugged into the compounding engine that had once been reserved for royal courts and merchant elites. Then in the 1970s, two revolutions collided. On one side, inflation, oil shocks, and the unraveling of the old Bretton Woods monetary system. On the other, innovation in finance. In 1976, John Bogle launched the first index fund for individual investors, a simple product designed to buy the entire market and hold it, at low cost, forever. And around the same time, the modern 401k system began, shifting the responsibility for retirement from employers to individual workers, turning millions of employees into self-directed investors, whether they were ready or not. But there was a darker parallel story. As financial markets opened up to ordinary people, credit markets did too. Credit cards, home equity loans, auto financing, student debt. Suddenly, for the average household, it was far easier to borrow money than to own anything that produced it. Cheap credit and clever marketing encouraged people not to accumulate capital, but to spend tomorrow's income today. While wages stagnated and living costs crept up, debt filled the gap. And the quiet, patient path of ownership was overshadowed by the loud, immediate promise of consumption. The result, over decades, was a new kind of inequality. Those who consistently owned productive asset stocks, real estate, businesses saw their wealth rise with global growth and financialization. Those who relied on wages and debt found that no matter how hard they worked, they were always one step behind. Economists would later describe this with a deceptively simple formula. When the return on capital is higher than the growth of the overall economy, owners pull away from earners. It wasn't a conspiracy, it was arithmetic, compounding, and access. Through the 1980s, 1990s, and early 2000s, the world embraced what was called shareholder value capitalism. Companies prioritized returns to investors, often at the expense of workers' job security and wages. If you owned broad slices of the stock market during these years, you watched your portfolio swell through bull markets in tech, globalization, and credit expansion. If you didn't, the distance between you and the owners quietly widened. The hidden path to wealth was still there, but once again, it ran mostly under the feet of those who never knew it existed. Then came the crash of 2000 and 2008. First, a dot-com bubble that seduced millions into chasing internet dreams, only to destroy trillions in paper wealth when it burst. Then a global financial crisis triggered by a housing bubble and toxic debt, which nearly froze the entire system. Many people concluded understandably that the market is a casino and walked away in disgust. And yet, the long-term story of ownership remained stubbornly intact. Those who held diversified assets, reinvested their income, and avoided panic selling recovered, and then surpassed previous highs. Now we arrive in our present moment, a time when the hidden path is more accessible and more obscured than ever. With a smartphone and a few dollars, you can buy fractional shares of the world's biggest companies in seconds. Index funds and ETFs make it possible to own thousands of businesses with a single, low-cost investment. Information, once confined to bankers' offices and dusty ledgers, flows freely. The gates to the Owners Club have never been more open. But here's the paradox. The same tools designed to democratize ownership can just as easily turn into a digital casino. Zero-commission trading, flashing charts, meme stocks, leveraged baits, social hype, these tempt you back into the oldest trap of all, mistaking speculation for investment. We watched it during the pandemic. A flood of new traders chasing rockets and slogans, some winning big, many losing quietly. All while a quieter group did something far less exciting, regularly buying broad, diversified funds, reinvesting their payouts, and going back to their lives. One group chased adrenaline, the other quietly walked the path that has worked for centuries. So what exactly is this hidden path? Stripped of all the jargon and mythology, it is the decision to become an owner of productive assets, not just a consumer of products or a seller of time. To tie your financial future, as much as you can, to the profits of thousands of businesses solving real problems in the world. To reinvest your income dividends, interest, rental yields instead of letting it evaporate into lifestyle creep. And then, perhaps the hardest part of all, to let time, not emotion, be the main force that grows your wealth. Compounding is not a get-rich-quick story. It's the story of how $1 earning 7 to 10% a year for decades doesn't just add, it multiplies. It's why an investor in the late 1800s who held a broad basket of US companies and kept reinvesting dividends could have turned modest sums into fortunes by the mid-1900s. It's why families who bought and held successful businesses or income-producing land ended up with influence far beyond the original effort involved. And today, it's why someone regularly investing a portion of a normal paycheck into broad ownership of global markets can, over 30 or 40 years, end up in a place that would be unthinkable if they relied on savings accounts alone. The difference now is not the math, it's the access. You no longer need to be a Medici banker in Florence, a Dutch merchant in Amsterdam, or part of the Rockefeller Circle in New York. You don't need a private letter from a banker to join a railroad syndicate. With a phone in your pocket, you can buy into the same kinds of companies that once built empires. And you can do it in small, regular steps. The ancient engine of ownership and compounding has been lifted from palace treasuries and placed, at least in theory, within reach of almost anyone. But access is only half the story. The other half is culture. Will we use these tools to walk the old, proven path? Or to chase new, faster illusions? History suggests that booms, bubbles, and manias will always come and go, dressed in new technology and new narratives. What doesn't change is that, over the long haul, wealth tends to flow toward patient owners of productive assets, not frantic participants in the latest craze. The path is hidden not because it's secret, but because it's psychologically hard, painfully simple, and incredibly slow. As you listen to this, we are living through yet another turning point. Inflation, interest rates, technological disruption, geopolitical tensions, uncertainty is the headline of the day. But look beneath the headlines, and you'll see the same quiet story unfolding that began in those medieval counting houses. A world where some people, in whatever small way they can, choose to accumulate slices of productive reality, while others are persuaded to constantly trade, borrow, and consume. In the long run, that choice, owner or observer, builder or borrower, may matter more than any headline, any election, or any short-term crash. The hidden path to wealth used for centuries is no magic loophole. It is disciplined ownership, reinforced by time and multiplied by compounding. And in our age of endless distraction, it is finally making a comeback. If you found value in uncovering this quiet force behind financial history, remember, the stories we tell ourselves about money shape the choices we make with it. On Hidden Finance, we'll keep revealing the structures, patterns, and strategies that have silently governed wealth for generations, so you can see the game for what it really is. Subscribe, follow, and stay with us as we explore more of the hidden machinery behind the fortunes of the past and the opportunities of the future, because in a world obsessed with quick wins and loud promises, understanding the quiet power of ownership might just be the most radical financial move of all.